We are actually not too perturbed about opinions that each brokerage house or wealth management firm states. It's their own view and their sort of thought on how Indian markets are likely to shape up. And we keep seeing that there are many forecasts made in the short run that the index will reach 70,000 by year end. Someone says it'll reach 45,000 by year end. It's a viewpoint, but you've seen how some of those views turn out. Even if you look at what happened in 2021, most foreign institutions were very negative on India, but we got the highest inflows. And it was one of the best years in the stock markets in India. Maybe on a relative valuation, since most major markets abroad have fallen, while we have stood resilient, it is appearing as an outlier. But if you see from a consensus on forecasts, India's EPS forecasts are also higher than most other economies, while Indian economy would probably be the highest or fastest growing economy during 2022. So from a long-term standpoint, I think India seems to offer better prospects now than ever. And hence, I don't know what to make of the view that Morgan Stanley has put forward. As I've said again, that while Indian stock markets are commanding a premium over other emerging markets, given our stable governance regime, our significant forex reserves, a large forex earnings segment that we have in the IT space, especially, lower inflation, if you look at compared to some of the other economies, lower debt to GDP ratio, I can keep going on, higher earnings growth, better return on equity, all are getting reflected even in the fall in our 10-year GSEC. So broad point is that we are much better placed. And I think next 5 years belongs to India. Markets have commanded premium valuations with respect to even MSCI. And the same will continue due to much better economic and political environment, as I mentioned earlier, a stable regime. If you really notice, Indian markets also have corrected vis-a-vis the peak valuation. And with trailing P's today at around 21, it is only a tad higher than the long-term average of 20. So we do not really suggest investing based on a single criteria such as valuation to decide entry points and exposure levels in a market. But we must see all the earnings potential and the operative macro environment to determine the expected returns. And in that, India really looks very, very strong and good. Similarly, we also discourage varying cash levels as a portfolio strategy to protect downside risk, as the market always tends to surprise earlier than we anticipate. And that causes significant underperformance of such a timing strategy. Rather, we would go for the right mix of various asset classes in a client's portfolio with weaker correlations between them and hold it for the longer term. Rupee has fallen only nominally, but not in relative terms, if you compare it with a basket of other currencies, or in real terms, when you adjust it for inflation. The rise of the dollar has led to some of these adjustments of most of the current currencies of the world, rupee being no exception. Rupee has also fallen less as compared with the other EM currencies, as I mentioned. So fall of rupee is broadly in line with the trend of other falling currencies. You look at euro, sterling, pound, all of them, have fallen significantly against the dollar. The reasons are very clear. There's a foreign outflow that has taken place, given what's happening to interest rates. There is inflationary pressure, which is more supply side related. That has led to the weakening of currency. We are a current account deficit economy. So when oil prices go up, that puts pressure on the rupees. So until energy prices stabilize, inflationary pressures sort of remain, or they stabilize, rupee will remain weak. All the other aspects also about the Russia-Ukraine war, COVID having disrupted supply chains, etc. All these have had a big impact on why rupee is falling. But having said that, in that fall, there are also certain segments or sectors that benefit, especially that are exporting, right? So there is a plus and minus to both of it. In fact, significant portion of Nifty earnings are linked to international markets and actually benefit from currency depreciation, right? So these trends are unlikely to be permanent. And over the medium term, India's attempt to revive manufacturing would restore its trade balance, reducing the dependence on capital flows to bridge the gaps. The market may see some volatility on account of this, but comfortable forex reserves and timely interest rate policies, which are very well managed by our central banks, can weather through most of this adverse impact. So once all of this stabilizes and comes in place, be it energy prices, be it inflationary pressures, be it the Russia-Ukraine situation, I think the rupee will, stabilize too. And we don't have to, it has a very short-term impact on the market. There's, longer-term basis, we'll be laughing about this a year, 2 years down the line. India is on a demographic autopilot in its path towards a higher income country. A conclusion we would achieve even if we were to assume a growth rate, that would slow down from the current level. And even if rupee were to continue to depreciate at the same pace, that it has been, we'd still be in a much better place given just the demographic so-called advantage that we have, the aspirations of people wanting to improve their lives. A bicycle person wants a bike person wants a car, one-bedroom house wants a two-bedroom house. It's just, the large population that is aspiring to improve their lives, along with a bunch of entrepreneurs who are really hardworking and generate the best return on capital as compared to any other country, I would say. Along with all the advantages that we have, some of the long-term thematic opportunities, including production-linked incentive that the government has put in place for driving manufacturing and exports revival, the push towards renewable energy, the infrastructure push, the amount of airports, roads that are getting made, logistics focus, banking and financial sector reforms. I mean, it makes India extremely attractive long-term opportunity. And the kind of reforms that have been put in place, even technology adaptation as compared to some of the more developed markets has been far higher than any other country that you can think of. So all these are making us believe that this decade belongs to India. It's going to be one of the most golden sort of phases that in the Indian economy. And we are rushing towards, we are already fifth largest. And there are many reports that do talk about us becoming the third largest in the next 10 years. From a broad canvas, investment-oriented strategies, we are more likely to succeed, where consumption is a very strong theme. So consumption as a theme in India will always do well. Banking and financial sector looks very poised for a very strong upturn, both from a cyclical standpoint as well as long-term opportunities. Auto sector is reviving again, and especially lots of innovation happening on the EV side. So that's again one area. IT sector, while they may face some headwind due to demand slowdown, but on a longer-term basis, this is again one area that we are fairly bullish on. So lots of segments, pharma, IT, that we can watch out, industrials. Certain sectors that we tend to avoid are metals and commodities because they're again very cyclical. You don't know what's really going to happen. But yeah, I mean, our favorite, I would say top 2-3 favorite sectors would be financials, auto and industrials. Markets have their own mind, so they'll keep remaining volatile as and when there are challenges or headwinds that they face. But an investor has to always look at equity from a standpoint of long-term compounding. And hence, first and most important is to arrive at what the correct asset allocation should be for you as an individual, that from your 100 rupees of savings, depending on your cash flow requirements, your risk appetite, how do you want to allocate your money between different asset classes? And once that is decided, then investing in today's environment, we are typically advising clients that their equity allocation, they can stagger over the next 3 to 6 months in a SIP format and invest. And the other investments in fixed income or alternative don't need any sort of hesitancy. They can always invest immediately. But equities in this environment, maybe stagger it. And once again, I'm stating we don't know how to time the markets. We have no idea what will happen in the short run. But from a long-term growth story, I think equities offer the best investment opportunity for all clients, and they must have a significant amount of their allocation towards it, done through a professional, focused more on quality businesses, through some of the vehicles like PMSs or mutual funds, etc., and maybe build a portfolio if you're a first-time investor over the next 3 to 6 months.